This lesson, I'll be focusing on disposal of fixed assets. However, I'll be taking you through bits of depreciation as it helps build us towards disposal of fixed assets. So what exactly is depreciation? I'm going to give you two examples to illustrate this. Type 1 kind of expenditure, reams of paper. For instance, these reams of paper cost $50. So you would see here, $50 is the whole entire cost of these 4 sets of papers. Now, the useful life is obviously less than 1 year because we use papers quite a fair bit in any office. So therefore, because it is less than 1 year, we call this an expense. Now, because it's an expense, it is totally expense in the profit and loss account. We would typically call it maybe stationery. Now, compare that with type 2 kind of expenditure. You have a set of furniture. Let's say, for instance, the cost of this set of furniture is $20,000. And of course, it's not going to benefit me for just 1 year. Okay, now I'm assuming that it will benefit me for 5 years. So I know that this is an asset because it benefits me for more than 1 year. So if you compare this with the previous example of the reams of paper are going to be used up totally, so the whole entire cost will be expensed. But in this case, I can't totally expense the 20,000, can I? I can't. So I've got to split it up into 5 years since it is said that I am going to benefit from it for 5 years. All right? So if you do that, you realize that at the end of year 1, I would have used up, okay, this portion in blue. Okay, in year 1, I would have used this up. So I would expense this to the profit and loss account. And this itself is the depreciation charge. Okay, so depreciation is an expense. All right, so we are slowly trying to expense the fixed asset across its useful life. Now, in year 1, because this is expense, right, you will see that this is also the provision for depreciation. Now, you would learn by now that the provision for depreciation is actually whatever that has been depreciated so far for that particular fixed asset. And since it is year 1, so this is what has been depreciated so far. Okay, and what is the rest of the 4 entire boxes here? That will give you your net book value. That means to say what I perceive, that I have not used up. Okay, so these 4 boxes are what I perceive that I have not used. So this is my net book value at the end of year 1. Okay, so now we're going to move on to year 2 just to further illustrate the point. Now the purple box here says year 2. All right, so this is expense in year 2. Okay, so this will go to the profit and loss of year 2. All right, so bear in mind, this one was year 1 in the profit and loss as depreciation expense. This is year 2, profit and loss as depreciation expense. Together, year 1 and year 2 form the total provision for depreciation so far. So your net book value at the end of year 2 is now left with 3 boxes. Okay, so I am assuming, because with this depreciation policy, that I have still not touched or not used these 3 boxes. I hope that's clear. So what exactly is depreciation? The definition of depreciation is a portion of the cost of the fixed asset. Can you see that this is a portion of the whole entire cost of the fixed asset? Like a part of a whole. All right? So, and the portion that is being expensed in that period. All right? So like, for example, your blue box here, this is the depreciation that is expensed for year 1. This is the depreciation that is expensed for year 2. Concepts involved in depreciation. Matching concept. Why matching? We have earlier mentioned that this is the cost of the fixed assets, and we're not going to expense the whole entire thing in year 1. We're going to split it up into 5 years that it is going to benefit us. So The first year, this is what we assume that we have used up. So hence we say that this is our expenses. We match that to our revenue to get a true and fair profit. That's essentially your matching concept. To match current year's expenses to current year's revenue to get a true and fair profit. And we do that every year. This expense is for year 2, this expense is for year 3, and so on. So here we are doing matching concept. Next is consistency concept. We want to say that we need to use the same method and rate throughout the useful life. One thing that I like you to note is depreciation expense is a non-cash expense. It doesn't deal with cash. It seems like it is a favorite exam question these days, and they like to ask, what is the effect of depreciation on bank or cash? The answer is there is no effect. Why is there no effect? Because if I were to buy a fixed asset, today, I would either pay up on the spot, or number 2, even if I bought on credit, I would definitely have paid up within a year. I can't owe for too long, right? Now, then when we go on to provide for depreciation in year 1, 2, 3, 4, 5, there is no element of cash because I would have already settled the payment. All right? So it is a non-cash expense. I would now like to bring you through the 3 methods of depreciation. First is straight line method. Sometimes they will say it's depreciation on cost. As you would know by now, this requires even distribution of cost over its useful life, so even depreciation throughout. So you can see it from the model given. And reducing balance method is sometimes known as depreciation based on net book value. So you would see that you will have most depreciation at the start, okay, and lesser depreciation as the years go. Okay, basically because these kind of assets, usually things like equipment, motor vehicles, you get the most benefit from them in the earlier years, hence you provide for more depreciation in the earlier years. Last method is the revaluation method, where you have this value at the start of the year, which is definitely more at the start of the year, and then you will have a lower value at the end of the year. Then you just take the start minus the end to get the depreciation charge for the year. This is by far the easiest method out of the 3. Let's now move on to disposal of fixed assets, which is really what I want to teach you for this lesson. Now, suppose you have a motor van and you have decided that you do not need it anymore. You bought it for 50k and now you want to sell it. Okay, let's just do it in simplicity. We assume that it's straight line method, and we have so far used it for 3 years. Now, in this 3 years, I have provided depreciation altogether 30k. All right, so your net book value is 20k. Okay, so this is net book value is really what I assume that I have not used. So the question is, if I have sold it for $25,000, would I have made a profit or a loss? Would I have made a profit or a loss? Well, if your answer is a loss of 25k, then you must have compared it to the cost. Well, if your answer is a profit of 5k, then you must have compared it to the net book value. So the question is, which is the right comparison? Okay, with that, I want to introduce you to this new formula. It says, gain or loss on disposal, you take net sales proceeds minus net book value. Now, the words here is net book value. So I do not compare to the cost, I compare it to the net book value. Why? Simple, because of depreciation. Because when we buy something, a few years down the road, it's not going to be as good as how it was first bought. But unless you're talking about things like land or antiques, whereby it will appreciate in value instead of depreciate in value. But in most fixed assets, they depreciate in value. All right. So like this motor van, when I first bought it, a few years down the road, I wouldn't be able to sell it for the same price, that I have bought it for, or even more. Okay, I can only sell it at a cheaper price. All right. So in this case, if I compare it to my net book value, I would have made a cool profit of $5,000 based on the fact that I think that, I have not used this part, okay, of 20K, okay, as I've already depreciated this over the last 3 years as expenses, then I would have already made a profit of 5,000. So I hope this part is clear. There are typically 3 accounts involved in a disposal question. First, you have fixed asset account. You have your provision for depreciation on the fixed asset account, and you have the disposal on fixed asset account. Now, in the fixed asset account, okay, as with all assets, to debit is to plus, to credit is to minus. Okay, so more fixed assets on the debit, less fixed assets on the credit. Okay, definitely when you sell, you have less. When you buy, you have more. All right, and then the next one is your provision for depreciation on fixed asset account. This is the direct opposite. Why? Because if you recall your model, okay, every time you have more provision for depreciation, you have a lesser fixed asset account figure. Okay, so to credit is to plus, to debit is to minus, the direct opposite of your fixed asset account. It is also known as the contra asset account. So contra always seeks to reduce, all right? And lastly, the disposal on fixed asset account. Now, disposal on fixed asset account, there's no debit is to plus, credit is to minus, or any of that sort. Okay, it works just like your profit and loss account. So to debit, okay, this side you have profit, and when you credit it, it is a loss. Okay, and it is a derived figure. Now, in the next few slides, I am going to walk you through 2 examples of disposal, and in it, I'm going to teach you a very important tool that is a table to calculate depreciation, and I think that is really, really important, and I hope that you can listen up for that. Okay, sample question type 1. Glacier started a retail business on 1st January 2010, purchasing 2 delivery vans for 30K each, paying by check. Alright, fast forward a little, let's find out what exactly are we required to do. Let's just do part A first. The motor vehicle account for 2010 and 2011. So if you look at this, 1st of January 2010, I bought 2 delivery vans, 30K each, paying by check. So how much does that work out? 30K times 2, right? So 60K. So because you bought, you have more motor vehicles. So plus your MV on the debit side. Clear? Okay. It is the firm's policy to depreciate the delivery van at a rate of 20% per annum on the net book value at the beginning of the year. This is also known as the reducing balance method. They are very, very kind to you over here. They tell you that net book value, okay, based on net book value, and then they tell you that it's reducing balance method. So it's really good. Now, the depreciation was to be recorded in a separate provision for depreciation account. Now, on 31st December 2011, after allowing for the second year's depreciation, okay, I repeat this. After allowing for the second year's depreciation, because you know why? You have used from 1st Jan 2011 to 31st December 2011. So, since you have already used 1 whole year, even though you are going to sell, but you still provide for 1 whole year's depreciation. This is according to what it says here. She sold one of the delivery vans for 15,000. So she sold for 15,000. Now, question: you are going to less your motor vehicles. All right, you're going to less your motor vehicles by how much? Is it 15K or is it 30K? All right, so the answer is you must minus 30K. Okay, why? Because you must recall that in this motor vehicle account right now, there is 60K. It's made up of 2 motor vehicles. If you're going to remove just 15K, which is the sales proceeds, by the way, okay, which is a common mistake made by a lot of students. They just take out this, somehow they will just take the sales proceeds figure and put it inside the motor vehicles account. Then you realize that you still have this 15,000 remnant of this particular motor vehicle that you're selling that is still hanging within the motor vehicles account, and you don't want that. Okay, so I made it very clear right now, saying that if there are 2 motor vehicles here, 60K, And obviously, if I want to sell one of the vehicle, I must take out one of it, which is 30K. All right, I hope this is really clear right from the onset. On the same day, Glacier bought a new delivery van for 36K on credit from Alpine's Motor Limited. So obviously this part she hasn't paid, so this is bought on credit. Bought new delivery van 36K, right? So you increase motor vehicles by 36K. So now let's have a look at the motor vehicles account. So quickly run through. At the start of Jan the 1st to 2010, okay, bought 2 motor vehicles, so 60K here. Nothing happened at the end of the year, no buying, no more selling, so you have balance carried down 60K. Now we're going to bring down to the next year, 2011, Jan 1st, balance brought down is 60K. Now you are going to sell. Remember, you're going to sell one of it. So take out the one whole entire full cost of it is 30K. Okay, put it inside the disposal account later. We will show you. And then you also bought on the same day another vehicle that cost 36K from Alpine's Motor Limited, which you bought on credit. You have not paid. That's why you wrote Alpine's Motor Vehicles Motors Limited here. Alright, so you just do a quick calculation. These two add together minus this, you should get a balance of 66K. That is the value, the historical value cost of the motor vehicle that you have at this juncture of 2012 Jan the 1st. Alright, we are going to look at the interesting and the most important tool that we are going to learn for this lesson next. Now presenting to you the very important tool for this lesson, the table. Right? So we understand that we use 20% per annum on net book value, or otherwise known as the reducing balance method, right? So here we go. Okay, sorry, I can't animate this one, so I will just go through bit by bit, okay? So let's start with this part here. Okay, how do we read this table? So we have always got 3 headings. So we have existing fixed asset, then the one that you are going to sell, sold fixed asset, and the one that you're going to buy, new fixed asset. So you just remember you must have these 3 headings, okay? Then we put the cost of it just right below it, okay? Is to facilitate the calculation of the depreciation, all right? So this is the one that we are not selling, okay? The existing fixed assets, 30K. And then this is the one that we are selling. Okay, because remember we are selling one of it, right? So 30K, the one that we're selling. And then we also bought a new fixed asset, which is the motor van in this case, right? So 36K. All right. So now we have 2 years that we need to calculate. So I bought it on 1st of January until 31st December. That's exactly 1 year. So there's no need for any proration. I just take 20% times 30K, the cost. For the first year, I get 6,000. Now the second year, because I need to use net book value, so I will take 20% times 30K minus 6K, last year's depreciation, and then this will give me 4,800. Okay, so year 1, year 2 for the existing fixed asset. Okay, I hope this is clear. Next, we go on to the sold fixed asset. Incidentally, it's the same. Okay, why? Because in the first year, 20% times 30K equals 6K, same as the previous one, right? Then in the second year, if you recall that they say after providing second year's depreciation, then they want to sell. So because of this, right, we also need to provide depreciation for the sold fixed asset, okay? So you will do exactly the same as this, because you use for 1 full year, all right? And then the next one is the new fixed asset. Because I didn't buy it in 2010, so obviously I don't have anything here. Then I only bought it on the last day of 2011. So it says that I don't need to provide depreciation here because I bought it on the last day. Okay, now that we have calculated this, okay, see all these in bold? I'm going to quickly walk you through what does this mean, okay? Now, if you sum up from here, you read horizontally this way. you actually realize that we are talking about the total depreciation for the year. How did I get 12K? I take 6K plus 6K. This is my total depreciation expense for the year 2010. Then you read this way, it is the total depreciation expense for the year 2011. So 4008 plus 4008 equals to 9006. Clear? All right. Then we move on. These two are important, okay, because you need to prepare your provision for depreciation account, right, in part B. All right. So in order to do that, you need to know your depreciation charges for each year. So you have already found it here. Next, another very important figure is this one, the one that you are going to sell. You need to know the total provision for that particular fixed asset. Okay, because when I'm going to sell that fixed asset, I'm going to take out everything of it, take out the whole entire cost of it, and take out the entire provision for depreciation that it has been provided so far. Make sense? So I'm going to take this out from the provision for depreciation. So you realize that it's very easy because you just have to take 2010's depreciation charge plus 2011 depreciation charge. You get 10,800. Okay, so I hope you can remember the figures because I'm going to pull out the answers. Okay, so you see I mentioned earlier that provision for depreciation is a contract asset. To credit is to plus, to debit is to minus. Okay, so I will always start with recording on the credit side. So recall in the first year, okay, just now the figure was 12K, right? Okay, it's made up of 2010 depreciation, the one that you read horizontally, 2010. Okay, so 12,000. Okay, so then after that, nothing happened because you didn't buy, you didn't sell. So you balance carried down 12K. Then you balance brought down again next year, Jan the 1st, 12K. Okay, then if you recall the second line, 2011, you read across 4008 plus 4008 equals to 9006, right? This is your 9006. All right. And then after that, what you do is, remember your disposal. Remember that I said that you have to take out everything of what you want to dispose. The cost, take out everything, and now you want to take out the provision for depreciation. Take out everything. See, taking out is on the debit side because you less. So take out 10,800. All right. So then you are left with 10,800. Then you bring down to the following year. All right. All right, and last but not least, you are going to prepare your disposal account. Okay, just a quick recap. This gain or loss on disposal, you just take net sales proceeds minus net book value. So here we go. Look at the disposal of motor vehicle account. Earlier on, you credited your motor vehicle account. So you bring it over to your disposal account by debiting it. Then earlier on, for your provision for depreciation account, you debited it because you less, and now you credit it. Now, actually, this is a really net book value. If you take a look, 30K minus 10,800 will give you 19,200. And you want to compare it with your sales proceeds. So 19,200, compare it with 15,000 that you actually receive as, for this particular sale. You realize that you actually make a loss, okay, of 4,200. Okay, but you don't need to calculate your net book value. When I told you about this net book value, is really to illustrate the model to you. Okay, if you recall what I said earlier. All right, so you just have to put this here and this here, and then you just put all these in place. You'll be able to find if it's a loss, it's here. If it's a profit, it is here. Okay, so we have come to the end of sample question type 1. This is sample question type 2. There are a couple of differences between this question and the previous one. Okay, the first difference is earlier on there were 2 fixed assets and you are selling one, and you actually bought right from scratch and you provide for depreciation from scratch. However, in this example, you will see that you don't know how many equipment are there here because it's like from ledger balances of 1st January 2011. So you don't know how many equipment are there here. And there is a balance brought down of for provision for depreciation of 15K. All right, so this is something different from the previous question. Of course, another difference is this is on cost and previously it was on net book value. Now, the third difference is this is a full year's depreciation is charged in the year of purchase and no depreciation is charged in the year of disposal. This basically means in the year that you buy the fixed asset, no matter if it's January, May, or December, you charge one full year's depreciation. The year that you are selling, you do not charge depreciation at all, whether you sell in February, March, or November. All right? The whole idea of this clause is to make it simple for you. That means there is no need for proration. Okay, you don't need to count until which month you sell it and so how many months you have used it, and then you start to prorate how many months in a year. So it is really to simplify matter. Next, okay, on July 2011, 31st July, this is the day that you are disposing. Okay, one of the equipment was sold for $8,000 cash. Remember, this is your sales proceeds, not your original cost of the fixed assets that you are selling. Okay, so earlier on, I already mentioned that this is your balance brought down, 60K. So you will use this, okay? This is the one that you are selling, so you will minus 12K from the equipment, all right? Then on the same day of disposal, you also bought some more, all right? So you add on to the equipment of 10,500. So here's a look at the equipment account, all right? You started off with a balance of 60K, and then you sold off, okay, the original cost, take it out, is 12K. Don't put the sales proceeds here. I repeat, this is a third or fourth time I've already said this. And when you want to buy some more equipment, you add on, okay, on the debit side, 10K 500. And then you will get your balance, and this is your new balance. We want to prepare the provision for depreciation of account next, okay? And first, before I bring on the very important tool, the table, I just want to show you the question again. So we must remember that we started off with a balance. This is a credit balance because it's a contra asset account. So a credit balance of 15K. Remember your depreciation policy is 20% on cost, okay? And then remember this clause, a full year's charge in the year of purchase, none in the year of sale. And also remember this date, okay? Now we are at 2011, 31st December, all right? But you bought this particular equipment on 2009. So you actually got to start providing for depreciation, because you want to find what exactly is the provision for depreciation for this sold vehicle. So when we prepare the table, we're going to see that we will start with 2009. All right, and of course, your new equipment you bought in 2011, so you only provide for depreciation for 1 year. So let's have a look. Okay, so here we go. It's 20% per annum on cost, which is the straight line method. So this is the table. Okay, I'm going to walk you through slowly. So okay, let's start. This is a little bit complicated. So let's start with the sold fixed asset. We know that the fixed asset that you are selling, the cost price is 12K, right? We know that the original fixed assets that you had initially was 60K. That means to say, you take 60K minus 12K is 48K is what you have, what you have for existing. That means the one that you are not selling, okay? The one that is existing and that you are not selling. Okay, so we can ascertain this, and this is important. You will find out in a bit why. All right, so we have already done this and this part. Of course, this one is just direct from the question. The new fixed asset cost, we just take it from the question, 10,500. Now I'm going to show you why is it that we need to start from 2009. Remember I said that we actually got this the fixed asset that we are selling in the year 2009. So because we started then, we have to start preparing from 2009. So the question itself says 20% on cost. So it's really very simple. It's not even net book value. So you just take 20% times the cost, 12K. 20% times the cost, 12K. 2004. Why is it that it is a dash here? Okay, if you remember just now, what was the clause? The year that you sell, 2011, you do not provide for depreciation. So the year that you sell, you do not provide for depreciation. Hence, you have already found a very important figure. The total provision for depreciation for this sold fixed asset that this sold fixed asset, 4,800. All right, which you are going to take out from the provision for depreciation account. All right, next one that we want to find is really your existing fixed asset. All right, so I'm going to show you. Earlier on, I mentioned that if you remember, look at the question. It is there is a balance brought down for provision for depreciation of 15,000. Now, if you think carefully, which boxes represent the 15,000? All right. If you can see it, I mean, I've already highlighted it for you over here. It's actually the blue box. Okay, if you take a look, whatever that is, before here, there could be some more, so 2008, 2007, and so on. All these add up plus these two should give you 15K. Am I correct? So you think carefully, all right, because it shouldn't include 2011. So whatever that has been done before. Okay, so anyway, if I want to find this particular box, okay, I will just take 15K minus 2004 minus 2004 based on what I told you earlier. Okay, so very quickly, I just want to tell you that it doesn't mean that this one stops at 2009. Now, this 2009 is really for the sold fixed asset. So this particular existing fixed asset, I could have some existing fixed assets that I bought in the year 2008. 2007, 2006, and so on and so forth. So this blue box could be, in an L shape, something like that. Okay, but of course I didn't illustrate it here because it will be very messy. All right. Why do I want to calculate this? Actually, there is no need for it for this question. However, if this is a reducing balance method, then you will need this box. So I am just showing you here so that you will know how to find this so that you can use it if it is for reducing balance method. Now in this question, you don't need this box because it is on cost, straight line method. So I just have to know that I find this 48K, then I just take 20% times 48K. Now if it was a reducing balance method question, then I will have to take 48K minus 10,200. Then I multiply by 20%, right? But in this question, no need. Okay, but if it is a reducing balance method, you know how you should find it. All right. So why do I need this figure? This figure is absolutely important because it tells me the depreciation for the existing fixed asset for 2011, which is the year that I need to prepare my provision for depreciation. All right. So this is existing now. So fixed asset, I already mentioned there is nothing because you're selling. New fixed asset, yes, in the year that I buy, regardless when, I'm going to provide 1 full year's depreciation. So just take 20% times the original cost, 2001. Add this and this, you get 11,700. This is another very important figure that you need for this question. So let's have a look at the answer. Okay, if you look, okay, you started off with a balance brought down of 15K. Then you dispose. Dispose means you want to take out. So take out is on the debit side. Dispose 4,800 from here. Okay, and this year's depreciation 2011, I already calculated for you earlier, is 11,700. Put it here. Then you add this less this, you will get your balance carried down of 21,900. All right. So next up, we want to do the disposal account. Okay, and the disposal account is as such. Okay, very simply, this is the cost price of the equipment that I'm selling, and then I minus your 4,800, which I already calculated earlier for you. So 12,000 minus 4,800, you should get 7,200. How much did you sell it for? 8,000. Oh, you made a profit of $800. So there we go. Put a gain here. Profit and loss account, gain $800. And this is the end of this disposal lesson. Thank you.